Hi, welcome back to the part 2 of the chapter 1. So in this learning objective, we wanted to talk about how the financial accounting information is communicated through financial statements. Okay, so for us to understand financial statements, we need to understand how to communicate from it, and then we need to understand what is the financial statements, right? So financial statements are periodic reports published by the company for the purpose of providing information to the external users. And there's a 4 forms of financial statements. The first form is called income statements. It's used to recording the primary or main operating activities related to the revenue and expense account. And then this statement is recording transaction during an interval of time. It's like a video that you shooting the video from the beginning of the period, such as let's say January 1st, and then shooting the video to the January 31st. And during this whole period or interval of time, that what happened to the company, what their economic transaction is, and then you all recorded in the income statement. You mainly focus on the revenues and the expenses, and then to calculating their net income. And the second very important statement is called a statement of the stock equity. This statement is to clearly listed the items that belonging to the stockholders, right? The stockholders claims right, and what is the components of it? How much is the common stock? Belonging to common stock, how much is actually returned earning over a long period of this, over the life of this company. And balance sheet is a interesting and very important statement. It's actually recording the economic position of an entity at a point of time. You can think of a balance sheet as a photograph. Like when we take a photograph, we take that picture as of that point, right? So if I take a picture at 2 p.m. today, that picture is gonna look like 2 p.m. today. And then tomorrow I took another picture at 8 a.m. That picture recording the 8 a.m. What's going on in the surroundings. Hence that balance sheet is not a story recorder. Balance sheet is the photograph that show you things as of that point. And income statement is a story recorder. It's recording everything happened during a period of time. A statement cash flow is a statement that showing the cash inflow and outflow of the entity that is related to the income statement. And also financing activity and investment activities. And a cash flow statement is composed by 3 major activities that we kind of talk about in the part 1 of the lecture. But all these statements we're going to dive in very details in this portion of the lecture. Okay, so income statement, as we mentioned earlier, is a report the company's revenue and expenses over an interval of time. And could be 2 kind of situation happen. One is that if revenue is bigger than the expense, then you will have net income, right? So when you sell more coffee than you expended on how much you producing that coffee, then you make profit, you make income. If the revenue is less than expenses, then you have net loss, right? So you're losing money. I'm sure a lot of time during this pandemic, a lot of small businesses are suffering because there's not enough revenue, right? And then there's maintaining daily and long-term expenses such as rent, utilities. So those things is gonna grow much higher than the revenue during the pandemic. Hence, a lot of business is enduring net losses. So the key point of that you need to remember is that the income statement compares the revenue and expenses for the current period. So maybe now this chapter we don't have a clear understanding what it means current period and what is beginning, what is end, and that's gonna be the chapter 2's main job. That is to explain to you that how do we consider what is current period, what do we consider is the future period. So, but in other words, that the income statement compares and records the revenue and expenses for the current period to assess the company's ability to earn the profit or from running its operation, right? So the purpose of the income statement is trying to tell you, am I making money or am I losing money during this period? Okay. I think I have to. Okay, so the next slide is that the income statement reports the company's revenue and expenses over an interval of time that we're talking about already, right? And this income statement compares revenue and expenses for the current period and assess the liability of making profit. Okay, so let's give you a quick example of what the income statement really looks like. So first of all, when we look at any kind of financial statement, we want to look at the heading. Heading is very important because without a heading, we really don't understand those items listed in the reports, right? So when we're doing the homework or exercise, we really need to clearly look at, am I looking at the income statement, or am I looking at balance sheet or statement of equity? And I also want you to pay attention to the period we are talking about. And this, based on this heading, is talking about Eagle Golf Academy, a place that teaches people how to play golf, and the income statement, their income statement for the period of month ending in December 31st, 2021. So during this month of December, what happened to Eagle Golf Academy's income statements? So first of all, we can see they make revenue of $7,200. At the same time, they incur a lot of expenses as well. They incur the rental expense and supply expense of $1,000, salary expenses for $3,100, utility expenses for $900, interest expenses for $100, and other expenses for $400. So total expenses for the Eagle Golf Academy is $6,000 during the December. And then the net income of this period of December is gonna be the $7,200, which is revenues, minus the expenses is the $6,000, and we get $1,200. Okay, and then let's look at the state of stockholder equity. And the stockholder equity is actually a summarization of changes in stockholder equity over an interval of time. So the concept of this statement is still recording what changed, right? So if, for example, it's still an interval of time, it's still a storytelling. By looking at this statement, we can understand what the stock equity account was and what happened during this period and what is current, which is ending period of stock equity looks like, right? So if, for example, I have a stock equity account, meaning that at the beginning I don't have anybody investing me yet, so I don't sell stocks, then my beginning balance is going to be zero. And then during this period of time, I actually accumulating a lot of resources, or I sold some stocks to the external stockholders, and then I increased my stockholder equity account, which is a place to put the transactions together. And then in the end, I have an ending balance of stockholder equity of how much, right? So based on this brief discussion, and we understand that the stockholder equity is coming from two places. One is external resources and one is internal source. The external source is money or financing resources that you gathered or you sell to outsider, which is investors. You list your company on the stockholder exchange and you sell your stocks and people buy your stocks, and by buying your stocks they give you cash and you give them stocks. So this kind of transaction is external sourcing transaction. And then there's another transaction sourcing is called internal sourcing, is that the money that generated is coming from inside, within this company, such as you during the period of activity, such like income statement, you made a revenue and you incur costs, but however in the end you had a net income bigger than zero, you have a net profit, and this net profit is gonna flow, is gonna be stored in the internal sources belonging to stockholders, because stockholders not only have a claim regarding how much money they give to you to set up your company, at the same time they enjoy your net profit. We talk about a little bit in the part 1, right? So in short, the stockholders' equity has two portions. One is the external source, one is the internal source, and we call the external source common stocks, and we call internal source retained earning. So the earnings can be distributed, right? So remember the example we gave in the part 1, we said we made $2,000 over the 1 month. We can choose to give dividend, cash, distribute this $2,000 to all the owners that have given you money, or we can return this portion of a profit and put them into the stockholder equity account to keep reinvesting your company. We call it returned earning account. We can return those earnings inside of the company, and this portion of money we call it internal sources. Okay, so let's look at example of statement of stockholder equity. So as we discussed, the statement of first of all we need to look at the heading. The statement of stockholder equity for the month ended in December 31st, 2021. This is December's stock equity statement of stock equity account, right? And we know there's two portions: common stock, which is external source, return earning is internal source, and then total together is actually total source. And the beginning balance of this account, we usually talk about when we talk about a story, we wanted to know what is the beginning and what is going on during the period and what is the ending period, right? So beginning is December 1st because it's a monthly statement, and the ending is December 31st because that's the end day of that month. And during the period, we find this company actually issued common stocks, and also it incurred the net income for the period. And then it also distributing the funding to the owners. Hence, the first transaction that issuing common stocks is the $25,000 is external resources. And then during the period of operation, there's the $1,200 that made by this company, and then it's net income. And then in the end of period that the owner decided to distributing some resources to its stockholders, it distributed a $200 dividend. Hence, the returned earning here is that although this company made $1,200 net income for that period, but they distributed the $200 back to their stockholders, then the return earning for this company is only $1,000 for this current month, right? And the total stock equity holder is actually equals beginning balance plus the issuance, because it's increasing, right? So when you're issuing stock, it's increasing the stockholder equity, and when you making money for the company, is actually increasing the net income and increasing the stockholder equity, because you kept them inside of the company, didn't distributing them, but the stockholders are still entitled to this $1,200. They're just not having it right now as distributing to them, but they can have it in the future. And then minus the ones that you distributed to them, right? So hence that the ending balance is gonna be 26,000. 25,000 plus 1,200 and minus 200 is 26,000, right? So all the time we need to remember the statement of stockholder equity is beginning balance plus issuance of stocks, adding the net income and less dividends, and equals ending balance. You don't need to remember the formula. I just want to give you a brief preview of what a stockholder equity account look like. Okay. Balance sheet. Balance sheet is the most important thing, as important as any statements, as we just talked about. There's something special about the balance sheet is that it presents the financial position of the company at a particular date. I mentioned that it looks like it's an analogy. The analogy is equals to a photo that you took, right? Today I took a photo at 8 a.m. I will look at the photo, it looks like that, but it doesn't record the story about what happened of that photo during the period before you took that photo, right? It's like as of today, what the company looked like. And then this report is talking about the resources and the claims to the resources. It's talking about the financial position of the company. What kind of resource this company has, and what kind of claim, who can claim of this resource, and who are they? What are they, investors or are they creditors? So the resource here stands for asset, and the claims to the resource here we mentioned a little bit earlier. It's liability, which is incurred because you borrow money from someone, and the creditors, right? You owe creditor money. And then stockholder equity is because you issued stocks to issue stocks, and then you tell people that this company can make a profit, can make high returns. So balance sheet is one golden equation is asset equals liability plus stockholder equity. Okay, let's take a quick look at balance sheet for the same company, Eagle Soccer Academy. And then also at the very beginning, we also need to really remember what is the look at the title, right? So the title of this statement is the balance sheet, and it's as of December 31st, 2021. So this photo is taken at December 31st, 2021. And let's look at it. Okay, so in this statement, we know the asset side, which is the resource side of this company, have cash, have accounts receivable, cash of $6,900, have accounts receivable of $2,700, have suppliers that $1,300, and have equipment of $23,600, has all other assets of $5,500. Okay, this is the resource side. What is the claims to the resource side? The claim to the resource side, we know is split into two parts. One is the owe to the creditor, called the liabilities, and one is invested from the stockholders. So the liability side, that we know there's accounts payable that we borrowed money from someone for $2,300, and we also owe our employee salary of $300. Okay, so employees money, utilities payables, and interest payable, all this being considered liability, because we didn't pay the employee, they become our debt owner. If we didn't pay the utility companies become our debt owner. And if we borrow money from from creditors, then creditors become our liability holder. So, and then we borrow long-term debt for $10,000, then the bank also we also owe bank money, and there's other liabilities. So all this adds up is the liabilities section of a balance sheet, and then the total of the liability is $14,000. And then another portion of stockholder equity is the stockholder equity of balance sheet, because the stockholders also have a claim to the resource of the company. And we just talked about the stockholder equity has two portions. One is common stocks, right, which is from external resources. One is the return earning, is internal resources. And then the total stockholder equity is $26,000. Now let's adding up whether the total liability plus total stock equity is actually equals the assets. That's our golden equation, right? Asset equals liability plus equity. Okay, so the total liability and stockholder equity is equals $40,000, and the asset, we add up all this together, also is $40,000. Hence, it's balanced, right? Okay, statement of cash flow. So, statement of cash flow measures activity involving cash receipts and cash payments over interval period of time. So basically, cash flow statement is also a story recorder. But it's only recording the activity related to cash, in terms of cash receipts from any transaction or cash outflow that I give cash to other people. So what's the difference between a statement of income statement and versus cash flow statement? Is a cash flow statement only recording transactions that involve cash. But there's a lot of transactions does not involve cash, right? There's the revenue we made but we didn't perform, and there's the money we actually already get but we didn't. It's not in cash form, right? So all these things, and then that's why the income statement is very important, and the statement cash flows is measuring the activity that only involve cash receipts and cash payments over interval time. Is also a story recorder. It's not as a point of time, right? So, and then we know there's a three kind of activity under the cash flow statements, because we're segregating them into cash transactions involving revenue and expenses activity. We talk about earlier is called operating cash flow. When the cash transactions are for the purchase and sales of investment for long-term assets. Doesn't that look familiar? Yes. In the part 1, we said it's called investing activity. Hence, here it's called investing cash flow. And the cash transactions that deal with lenders and stockholders, that is the transactions that we gather external funding resources for the company. We call the financing activity. Hence, the cash flow statement is composed by three kind of cash flow activities. One is operating cash flow activity, one is the investing cash flow activity, and one is the financing cash flow activity. And let's take a quick look at what is a statement cash flow look like. So this is also Eagle Soccer Academy's activity, cash flow activity, and it's also for the month of December. Okay, from an operating activity perspective, we can see there's a cash inflow and there's a cash outflow. So we categorize cash flow activity into three categories, and within each category we have inflows and outflow. So the operating activity, cash flow from operating activities, the cash inflow from customers, cash outflow for salaries and rents. So based on this transaction, I know Eagle Soccer Academy received the customer's payments for $4,900, and then they paid cash to the employee $2,800, and they paid the rent for $6,000 in cash. Hence, the net cash flow from operating activity is $3,900, because the outflow is higher than inflow. So that's why, from the operating activity perspective, there is outflow of cash. And then let's look at the cash flow from investing activity. So there is a purchase equipment. Investing activity means that cash flow, the purpose of such cash flow is to serve in multiple periods in the future. Is to benefit the company for long term in the future. Hence, the purchase equipment is considered as an investing activity, because it's the purchase, right? That means that the cash is outflowed, and that's why. And then there's nothing else that happening in terms of investing activity during this period. Hence, the net cash flow from investing period is $24,000 outflow. And then let's look at the cash flow from financing activity. Financing activity, we talk about it, is the activity deal with the creditors and investors, stockholders. So first of all, the issue common stocks activity is that the Eagle Soccer Academy issues stocks in exchanging money from external investors. And when you issue common stocks, there is a $25,000 cash inflow, right? Inflow means that cash flow inside the door. Outflow means cash fly outside, means I give people cash. So when you issue stock, you give people stocks and they give you money. Hence the issue common stocks is 2,500 inflow. Inflow is denotated in the positive, and outflow denoted in the bracket means the negative. Anything in the financial statement, if you see a bracket, that's negative. Okay. Anything you look at, it's like positive. Without a bracket, that's positive. And borrow from the bank. When you borrow from bank, you actually enter into a contract or covenant. Hence, the bank will immediately give you the amount that they approve to loan you, so that $10,000 from bank is cash inflow. And when you pay dividend, which is dividend also the activity related to the equity holders or creditor, right? So when you give dividend to your owners, to your equity holders, that means that you have $200 outflow. Hence, the net cash flow from financing activity is $34,800. And this cash flow activity is going to be linked back to the cash account inside of balance sheet. Because by doing cash flow statements, we can reconcile, we can verify whether our income statement relationship and the balance sheet relationship balance is correct. It's flow through, it's checked, it's a food checked. So net cash increases. So after we consider the 34,000 inflow from the financing activity, we add up all three activity together. We find out that during this period of time, this company actually have $6,900 inflow, right? Because we're adding these three activities total together, which is in the most right column, minus 3,900 plus minus 24,000 plus positive 34,800, you will get 6,900, right? So that means in total, the net increases, the net cash flow of this company during the period of December is positive 6,900. And the cash at the beginning of the period, let's say because it's the beginning of this company, is 0. Hence the ending period, it should be 6,900 because ending balance always equals beginning balance plus changes during the period. The changes during the period of this company is 6,900 plus the beginning of the balance of the cash is 0. Hence the ending of the cash is 6,900. Okay, so then please do not panic about this screen. And this is a perfect and wonderful way to illustrate to you that how the funds transfer between each account and each statement. How do we link income statement of stock holder equity, and balance sheet and statement cash flow together? Okay, so that means each transaction, economic transaction happen in every time, every second of the firm, you always can find a correct categories to park them in, because all the money flows through all the statements. Let's look at here. So starting from income statement, Eagle Soccer Academy income statement we just talked about. they made $1,200 net profit, net income, because their revenue is $7,000, their expenses $6,000. As revenue minus expenses equals net income is giving us $1,200. So this is number one. Number two is that this net income is part of internal resources in terms statement of stock equity, right? We talk about the statement of stock equity have what? External source and internal source. And the internal source break down to net income and dividend. Net income is account increase the return earning, and dividend is account decrease the return earning because it's distributing to the owners. Hence, through this through the income statement, we know $1,200 should flow to statement of cash flow, statement of stock equity to increase the return earning account. At the same time, the firm declared the $200 dividends, which gonna decrease return earning. At the same time, the company issued common stock for $2,500. Hence, this company's total stock equity is $26,000. And this $26,000 is gonna show up at the stock equity account on balance sheet, because balance sheet has asset side, has claims to the resource side, which is liability plus stockholder equity. And the stockholder equity here is going to be the ending balance. Number two here is going to be the ending balance of the statement of stock equity account, right? And then we can see is the cash in the balance sheet has to equals to the ending balance of the statement of cash flow. The cash flow during the period has three categories: cash flow from operating activity, cash flow from investing activity, cash flow from financing activity. Then we detect that adding all these three things up, there's a net increase in cash of $6,900 because there's a zero cash in the beginning of the year. Hence, the ending balance of cash is $6,900. This number, cash flow number, need to be reconciled with the ending balance of cash, which is exactly how much money you left in your bank. These two has to be equal. Okay, so this way we actually linked everything together. So number one point is that the amount of net income in the income statement appeared in the statement of stockholder equity statements. And notice that the ending balance of the statement of stockholder equity reappears in the balance sheet's stockholder equity account. And the number three is that cash flow, the amount of the cash in the balance sheet, reappear as the ending balance of cash flow. That's how we link these things together. Okay, so the key points that take away from this this objective is that all transactions that affect the revenue and expenses are reported in the income statement ultimately going to affect the balance sheet through balances in return earning, right? And then besides all these accounting, that in the financial statements, there's nowadays the financial statements that are published by the company put on the Stock Exchange Commission website is more than 100 pages. And you will tell me that, well, I just look at the Eagle Golf Academy and most 5 pages. Why there's 100 pages of the annual report, 100 pages of financial statements published by SEC, published by the company, put on the SEC's website? Because there's more information than just the statement themselves. The statement is the most numeric way to summarize the transactions happen to the company. But we also use a lot of narratives and text to explain in details of what each component really meant. In general, there's two other information that you need to kind of pay attention to. One is called the management and discussion analysis. Another one called the no disclosure to financial statements. What does the management discussion analysis really do is that in that section, right, besides the financial statement section, income statement, balance sheet, report, statement cash flow, stock equity cash statements, this called management discussion analysis section, MD&A section, is typically include management views on the significant events and trends and uncertainty pertaining to company's operation resources. It gives the management opportunity to explain what's gonna happen, what is happening, what happened, and then to give the financial users more detailed information to help them to decide whether they still want to keep investing in this company or whether they want to sell the company stocks. And the note disclosure is another form of other information that disclosed to the outsiders. Note disclosure is actually offering a more technical information or additional information, either explain the information presented in the financial statements itself or provide information not including financial statements. Normally, they explain why we recorded this transaction, why this account is this much, and what happened to this account, and what is the regulators' requirement for that account, and what did we do to comply that. Okay, so this is a lot in terms of Object 3, probably is the hardest part of this chapter. Hence, I just want to make one video of it, and hopefully we can do some exercise together during face-to-face time in the class time, and we can get more understanding of how things flow through. Okay, I see you in next video. Thank you very much.